please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The budget is behind us, and now the Reserve Bank's monetary policy is the next big event ahead for financial markets. As always, CNBC TV18's Citizens Monetary Policy Committee meets ahead of the meeting of the RBI's official MPC to ponder over the factors that the Reserve Bank has to consider. And this time, there is a sea change, with the budget somewhat changing the arithmetic on both CPI's trajectory, the inflation trajectory, and the fiscal deficit. The bond markets, which were already in some turmoil, continue to see jitters. It is a tense meeting, folks, and my committee is here to decode what the RBI's MPC ought to consider. Joining me now are Chairman Dr. Pranab Sen, former advisor to the Planning Commission, former chief statistician, and members Sonal Verma, Managing Director and Chief India Economist at Nomura Financial Advisory Securities, Soumya Kanti Ghosh, Chief Economic Advisor, State Bank of India, Sajid Chinoy, Asia Economics, JP Morgan, Dr. Samiran Chakrabarti, Chief Economist, Citi. Gentlemen and lady, thank you very much for joining us. Well, let me start with you, Sajid. The trajectory of inflation first. Has it changed materially with the budget saying that MSP, minimum support price for crops, will be 1.5 times the cost of production?
It has changed, Lata. I think, remember when the RBI last met in December, oil was still at $62, and there was a sense that this could mean revert back to about 55, which was their forecast at the October monetary policy review. Now there's much more confirmation about three things. One is that oil may well be in close to $70 for most of 2018. There's much more confirmation about global growth and therefore the spillover to India. And the third risk, as you pointed out, is the minimum support prices on the budget. So even without looking at the MSP impact, we're looking at average inflation in 2018 being about 5%, maybe a little bit higher than 5%. And this is without the MSP impact. If you now add the MSP impact, of course, it will depend on, you can do this in various ways. Is this a one-off? Which cost structure do you use? But even conservatively, this could add 60-70 basis points to headline CPI if taken to its logical conclusion. So that would be worrying, because then you get into the 5.5% to 6% range. And I'll make one more point. I think from the central bank's perspective, it's not so much just the one-time increase in prices. When you begin to adjust minimum support prices to costs, right, what you essentially do is introduce a lot of persistence to the inflation process. Because if there is a shock to costs in any one year, that translates into higher support prices, which then in turn affect food inflation and inflation expectations. So I think the whole point in the early part of this decade was to break that wage price cost and expectation spiral, and by linking MSPs to the cost base, it does increase more persistence into the process.
Okay, this is sounding actually quite hawkish. Soumya, what would your take be? We were, as macros go, both the Reserve Bank and the government were fixed on reducing reducing inflation. Now, Sajid is saying that we are structurally putting an element into higher inflation because of this cost push via MSP. Would you go that far? Is your number also 5+ for the year?
Before the MSP, I'll come to the MSP part in a bit. But before the MSP, our inflation trajectory in the calendar month of 2018, January to June, was in the range of 4.5 to 5%, with some inflation negative surprises. But the second half was supposed to be better in the lower range, 4 to 4.5%. Now, after the MSP, I think there is, whether MSP will add to inflation, I think still the jury is not out in the market. I'll give you an example. If you go through the budget speech very closely yesterday, what the FM said, he has been clearly saying that it will be 1.5 times of the cost. But there are two elements to the cost. The way this cost is calculated is either through A2 or C2. These numbers are given. Now, if it is on C2, then only it becomes meaningful. Otherwise, on A2, it's already factored in. Okay. Now, the other paragraph which he clearly says, FM, is that we will want to ensure that the farmers get a commensurate benefit if the market price goes below MSP. So there, I think, is an element that the government could actually be thinking of a scheme which is currently prevailing in states like Madhya Pradesh and Haryana, where it is covering all the crops. Because MSP as of now, if The problem with the MSP is that why it has led to food inflation was only for 3 to 4 crops. Now this will cover all crops. And in such a scenario, if you actually do a simple arithmetic and try to differentiate between what will be the cost actually comes to 1/10 of the date waiver which the government has announced. And that also reduces the procurement cost substantially, because you are just trying to compensate the farmers for the difference between MSP and the market price. So I think if that is the scheme which the government is thinking, and that has been clearly said in the paragraph that it is still needs to be worked out,
yes,
then I think it could have the impact on inflation would not be that significant. Yeah. But as of now, I think there is still uncertainty in how the schemes to be worked out. But I am sure that the government is cognizant of the risks to inflation from an MSP hike, and they should try to to minimize this without by at the same time compensating the farmers for the price loss.
Okay. Well, Samiran, that of course reduces the risk somewhat if the jury is still out on whether it's going to substantially increase food inflation. Generally, have the risks to inflation increased? What should, as an MPC member, what should you worry about?
So I think Sajid mentioned about the oil price issue as well. We're discussing the MSP issue. I think beyond these two, on the negative side or on the higher inflation side, the thing that I'm more worried of is that in the month of January, we have seen at least 3 critical intermediate inputs prices going up substantially: coal, electricity and cement. To what extent they have a pass-through effect on the prices of other commodities is something which needs to be seen. On the positive side, the decline in vegetable prices that we were anticipating, that finally seems to be going through. So to some extent, that can mitigate the near-term inflation risks. And if I really want to take a kind of contra position to the MSP argument, yes, I quite get it that on a headline sense, it's probably a time to raise some caution. But we have seen historically that the correlation between MSP increase and actual market price increase is quite weak for most of the crops.
What gets into the CPI though?
It is the market price which gets into the CPI. MSP has a very small weightage in CPI. So this is the market price which matters, and this correlation can completely distort things over time. And last but not the least is a very odd comment in the budget speech, which says that for Rabi crop, with this only a 6% kind of MSP increase, the government has been able to achieve the 1.5 times of cost of production already. So if 6% is valid for Rabi crop, why would that number be significantly higher for summer crops is not very clear to me.
Okay, so that again makes me feel that, well, things can be bad, but not that bad on the food front. But you have raised 2 other areas or 3 other areas which can inflate the price line. Sonal, your thoughts. Now, do you think the MPC has to be on the front foot in terms of monetary policy because of changes in inflation?
I think caution is surely warranted. On the global front, the growth signals are positive, commodity prices picking up. On the domestic side, growth signals looking positive. We might not have yet seen a significantly better growth number, but the initial indications are that growth numbers in the coming quarters will be positive, and therefore the focus has to squarely be on inflation. I think one of the biggest achievements for Indian economy has been the moderation in food inflation over the last 3-4 years, which has been possible because of various factors. And we've now come to the inflection point where prices, fell to such a level, completely imbalancing the balance between farmer and the producer. And we're now at a threshold where, from a political perspective, the need to support food prices for rural incomes to grow is clearly there, whether that's happening through support prices increases, through trade policy measures, or, through mechanisms to ensure that farm prices remain closer to support prices. So if the food mechanics and the food inflation cycle starts to turn around at a time when the oil price cycle is turning around. Both food and fuel play a very important role in expectations, and this is all happening at a time of rising input costs and a cyclical recovery. So the focus has to squarely be on inflation and to ensure that the moderation in inflation expectations which has been achieved over the last few years actually does not get derailed.
Okay. Chairman, your call, sir. You have traditionally worried about the cost of capital and the impact on a large number of, small industries and consumers. Your take, after all, the RBI didn't cut so much when inflation even went to 1%. So should the MPC therefore give a long rope and not immediately move at the first signs of inflation?
Well, the MPC has a problem, which is that we know about oil, we know about the uncertainty surrounding MSP, but what doesn't seem to be talked about is the fact that we seem to be reverting in terms of our protectionist stance across a wide range of consumer goods. And remember, I'm again saying consumer goods, enters directly into your CPI. You're seeing increases in the tariffs. What effect that will have, I don't know. But the fact is that there seems to be a reversion in terms of our position on global trade. And I would think that inflation risks have gone up, and have gone up significantly because of that.
Well, actually, both Sajid and Dr. Sen are raising a very important point that, the government seems to be turning away from its previous character in the last 4 years of keeping prices down, and has taken 2 steps which might push inflation up. More on what can be expected from the fisc and what the MPC should take on board. Well, before going to the break, Chairman Sen said that the government, by raising duties, has probably pushed up costs, and therefore the government's contribution to inflation has actually been adverse, so to speak. Let me put the question on fiscal deficit, actually. Sajid, fiscal slippage, if one had followed the original path, the budget estimate of FY18 was 3.2. One should have expected at least 3.1. Technically, from budget estimate to budget estimate, we have got a kind of a reversal on fiscal consolidation. Short point, there seems to be fiscal looseness, so should there be monetary tightness?
I think the MPC worried about this at the last policy review, but I think the MPC will be forward-looking. Some amount of fiscal slippage this year was understandable given the exceptional circumstances surrounding GST. I think what the MPC will focus more on is what is the likelihood that we can achieve the targeted consolidation next year from 3.5 to 3.3, look at the assumptions around that consolidation, and I think that, and the composition of expenditure. I think current expenditures come down as a share of GDP, while capital expenditures are preserved as a share of GDP. I think the MPC will want to ensure that both you get the consolidation and you get a better composition of expenditures. I'll make one point, Lata, that if you look net of asset sales, in 2007-18, there was actually a fiscal expansion by the center, right? And I think what the RBI will want to be sure is, in this environment of strong global demand and accelerating growth in India, that the fisc is consolidating net of asset sales in 18-19. So I think it'll be more forward-looking.
Well, Soumya, the bond market appears to have already priced in that things have gotten inflationary globally and maybe in India as well. So how will that input figure into the MPC's deliberations?
No, so I think in terms of the bond market dynamics, I have a sense that the bond markets may have overreacted, because the 3.5% fiscal deficit was already factored in by the market. And if we actually look into the differential now between the repo rate and the 10-year yield, it's actually close to 200 basis points. And the last time when we had more than 100 basis points was in 2013 and 2019, which were in times of crisis and also in times of significant outflows. This year we had a significant capital inflows into the system, and still we have a system whereby the 10-year yield is actually shot up to 8%. And what Sajid was saying in terms of the fiscal consolidation, if you actually break down the numbers, you will find that the borrowing program, net market borrowing program for last year, net of buybacks and switches and repayments was 4.02 lakh crores. And they say the number is coming down to 3.90 lakh crores. So there the government has tried to optimize its fiscal position in terms of the prevailing uncertainties, and I think the market should take solace from that. The expenditure growth is lower than the GDP growth rate, and if we actually look into the breakup of the revenue expenditure deficit as a percentage of fiscal deficit, that has come down, though it needs to come down substantially to below 50%. So in my sense, I think the markets is a little bit overreacted to the current situation. Possibly it is looking ahead and thinking that we may be possibly there could be some the monetary policy could be tightening. But as of now, I think that if a better communication to the market could actually help the market to overcome the current phase.
Okay, well, some communication has come from the government, and let's see whether it is followed up with any action from the Reserve Bank. Shamiran, what should, as an MPC member, what would you worry about in terms of fiscal looseness?
Well, I think the numbers need to be seen in the context also, that we should not be too much focused on the central government deficit, but look at the general government deficit. And whatever slippage we have seen of about 0.3% of GDP in FY18 at the central level, if to some extent the state governments does it a little better, then maybe the overall slippage is not as much as what we are thinking just looking at the central government number. But I think the bigger concern at this moment is about the credibility of the FY19 estimates, particularly on both the revenue and the expenditure side. And I'll just want to take up two of them. One is the GST revenue collection, which is where our estimate is that the growth rate assumed is about 11.5%, which is similar to the nominal GDP growth rate number. But there are some concerns that actual estimates are much higher than what I am saying. Okay. So there is some confusion around that. And the other area is this National Health Insurance Scheme, for which as of now there has been nothing budgeted, but the FM seems to be indicating that this will be fully funded by the government. So when and how this scheme will be announced and what will be the fiscal implication, not just for 1 year but over multiple years, that's something which would be making people worried about the credibility of the fiscal numbers.
Okay. Well, let me quickly ask you a follow-up. Therefore, do you want, as an MPC member, your target is 4% inflation. Should you be on the front foot to tackle any potential fiscal looseness? Should the MPC either already hike or be very close to hiking?
I think the so-called slippage that we have seen in a transitional year of demonetization / GST introduction is not something which I would be tremendously worried about. I would also be to some extent comforted by the fact that officially the government has adopted the FRBM target of debt reduction, which I thought was an extremely good move to have. But yes, incrementally now I will be watching the numbers more carefully every month on both the GST collection as well as any one-off expenditure increase. Because once you start thinking on lines of populism, then it could be on a slippery slope where you can deviate from the target on expenditure very quickly. So that's something which I will be careful of. Okay.
Sonal, as an MPC member, would you already be on the front foot? Should a hike come this time itself, or should, as an MPC member, you will indicate that a hike is around the corner?
Well, I think if you, truly, analyze the CPI inflation number, part of the increase has been because of the statistical house rent allowance, and part of this is also the one-time, GST effect. well, one-time GST effect, we have to live with it. But if you strip out the HRA effect and the petrol diesel part, then the underlying inflation numbers are actually around 4.5%. So the headline numbers obviously exaggerate where the reality is. So at around 4.5% underlying inflation at this stage does not call for a policy action. But I think there are a few risks on the horizon. While the budgeted quality of consolidation seems to be good, the fact is that if GST revenues disappoint, or if oil prices move up, the petroleum subsidy number is under budgeted, then essentially capex is going to get cut again as it was in FY18, and therefore the quality of consolidation can take a hit. Second, the medium-term commitment is there, but the target of 3% has now been pushed out by 2 years to FY21. And third, as we discussed earlier, bringing back a cost-plus mechanism on MSP, even if a lower cost formula is adopted, it still implies a 10-15% increase in a weighted average Kharif MSP, and that can have implications if there are other measures, complementing, other policies, food-related policies that ensure that prices remain closer to support prices. So the point is that at this stage, inflation vis-a-vis where the repo rate is all right, and therefore doesn't call for an imminent action. But there are risks on the horizon which does call for a more cautious stance being undertaken.
Okay, Chairman Sen, what else would you want your committee members to consider before they vote on what the action should be?
We've talked a lot about MSP, but MSP doesn't actually enter the inflation numbers very strongly. What does enter is what the decisions that the government takes regarding issue prices, and what happens when there are divergences from the MSP. That is the bigger game. I mean, the government has already indicated that they're going to be implementing something like a cash reimbursement in case prices fall below MSP.
Okay.
The magnitude of that we have no idea of. So we're today in a situation where I think large components of public expenditure are unspecified in the budget. Now, this is not something that's going to suddenly bite you in the neck, because since it's not in the budget, it will come up in the supplementary demand for grants, which means sometime around September. So insofar as the coming quarter is concerned, I don't think we need to take them into account. But nevertheless, keep our powder dry. Okay,
members, please write out 2 votes. One on how you will vote now on the rate action on Feb 7th, and 2 on what should the Monetary Policy Committee stance be. Sajid, your vote on rate, whether the rate should be hiked or paused or cut on Feb 7th? Yes. Okay, Samiran, your vote? Okay, that's a pause vote as well. Soumya, what would your vote be? Okay, so Soumya also has a pause vote, so that's 3 of you with a pause vote. Sonal, your vote?
A hold.
Okay, it's a hold as well. So all 4 votes have gone to don't act now. Dr. Sen? Okay, the chairman doesn't differ either. So the MPC unanimously wants no rate action. But on the stance, Sajid, your call, what should the RBI stance be?
So I still think there'll be a neutral stance, but I think the tone will be meaningfully more cautious.
Okay. Samiran, your stance? Okay, it's a cautious stance. Okay, so no change in the actual language, neutral.
It will be a neutral stance with a little amount of caution.
Okay. Sonal, what will the stance be?
A neutral policy stance, but highlighting the rising upside risk to inflation.
Okay, so the tone changes. Dr. Sen, what would the chairman want to say on the stance? Okay, that's cautious. Well, all members want the MPC not to do any rate action on February 7th, but the stance will be materially cautious even if it remains neutral. Thank you very much, members, for your deliberations.